Inflation is the rate at which the general level of prices for goods and services rises, causing purchasing power to decline. While moderate inflation is natural in a growing economy, excessive inflation can be detrimental. The Consumer Price Index is a common measure, and recent years have seen inflation rates climb above the typical 2% target set by central banks. In 2024, the US faced an inflation rate of about 4.5%. In September 2025, the US inflation rate was about 3% on a 12-month basis, which can significantly impact household budgets. First, let's examine the direct cost. Inflation directly impacts the cost of daily necessities: food, fuel, utilities. A family that used to spend $100 on groceries might now spend 110 or more for the same items. Gas prices rising by even a dollar can add hundreds to your monthly expenses if you commute regularly. According to the US Bureau of Labor Statistics, food at home prices rose by 2.7% for the 12 months ending in August 2025. This is a deceleration from previous year, though some individual categories like meats, poultry, fish, and eggs have risen more sharply. Beyond the immediate expenses, inflation has indirect effects on savings and investments. If inflation outpaces your savings account interest rate, which for a savings account in the US is approximately 0.40 to 0.62%, you are effectively losing money. Your savings are worth less over time. In terms of investments, fixed income products like bonds might offer returns beaten by inflation, reducing their real value. US Treasury securities, considered among the safest investments, recently yielding around 4.6 to 4.9% on long-term bonds. Meanwhile, stocks may be volatile, with inflation causing market instability, but in the last 33 years, the S&P 500 index had a compound annual growth rate of 11.2%, which beats inflation. Inflation can also subtly alter the dynamics of debt. While existing fixed rate debts like mortgages may seem easier to pay off with rising inflation, since you are essentially paying them back with cheaper dollars, the average interest rate for a 30-year fixed rate mortgage in the US is approximately 6.07% to 6.28%. On the other hand, variable rate debts can become more expensive, but currently fewer than 10% of new mortgages are adjustable in the US. Interest rates on credit cards and lines of credit might rise alongside inflation, increasing your financial burden if you carry balances. So, how do we combat this hidden cost? Here are some strategies. Budget adjustments. Regularly update your budget to reflect price changes and identify areas to cut back. Smart purchasing. Buy in bulk, use coupons, and take advantage of sales to save on groceries and household items. Third, reevaluate investments. Diversify your portfolio to include assets that typically perform well during inflationary periods, such as commodities or inflation protected securities. Finally, debt management. Focus on paying down high interest debt and explore fixed rate refinancing options for variable debt. Inflation may be an inevitable economic phenomenon, but its hidden costs don't have to take you by surprise. If you find this video helpful, please like, subscribe, and share your thoughts on personal strategies for managing inflation in the comments below. Thanks for watching and stay financially savvy.